Well, the fact that we saw such an acceleration in the services revenue, surely that gives us a pretty clear answer on that, doesn't it? That the iPhone for this particular quarter was less of a significant driver. So there is a real coronavirus phenomena at work with Apple. Would you not anticipate that we'll see some of this strength dissipate as we see the lockdowns coming off ultimately?
Yeah, I mean, my core thesis is that we need to be looking at the post-COVID environment. There are names that are clearly work from home, maybe some of the smaller names that I think are very vulnerable to a kind of step back or an underperformance period. And then amongst the mega cap names, you've got some which are more COVID working from home related and some and others that are not. Apple probably sits there as one with a clear boost. The fact that iPad growth was 40%, a new record. Really pays testament to that. As you say, services growth, although I think that was also partly driven by the Apple One bundle, which was very strong. And so, that may reference into strength for some of the companies involved in that bundle, like Spotify and Peloton, for example. But I think that I think you're right. We will see an element of dissipation of growth as we move out of COVID. And then amongst the really big companies, a company like Amazon is probably even more impacted in that respect. So I think one's got to just calibrate which companies have had the most benefit.
Mark, I'm sorry to take you back to the broader theme, though, but given the oscillation, the violence we're seeing in these markets as well, don't our viewers who like these longer-term secular IoT stories that you mentioned in your copy as well, and I get IoT, I think it's fantastic, but I just think we're going to see some violence continuing. Now, a lot of that violence has been to the upside. Why shouldn't that violence be to the downside and then hit all of these big companies, good companies, secularly changed companies as well, hit them just as proportionate as well as people have to liquidate positions?
Okay, so I think you make a good point here, but trying to time the market is never easy. I think that there is a risk that these mega cap companies are hugely over-owned. They form the backbone of many, many portfolios. I've seen ETFs, even mid-cap ETFs in some cases that have companies like Apple and Facebook and Amazon as key holdings. So I think there's a big over-ownership issue. And if we do get a kind of rocky period, then those mega-cap companies can easily underperform. And so I wouldn't be against being underweight them. But I don't think you can just be out of the market and hope to try and time a dip, because with the amount of money that's being pumped into the system, we just don't know when that dip is going to occur. So I think, again, I go back to my point. Find the companies that are cheap, that represent great long-term growth, and be involved with those and add to them if they come down.
And you mentioned the next wave, so let's talk briefly about that, Mark. Reflation, it's postponed, is it, rather than cancelled at this stage? And if so, what do you want to own?
So I think that there are two kind of main theses here. One is to look for stocks which are beneficiaries of a post-COVID world, so of a kind of more cyclical recovery. But structurally, I much prefer now a move to what I call Digital 4.0, which is the Internet of Everything. We've had a big period of success for the platform businesses, but I think we're going to see connectivity of everything, which is going to drive a lot more disruption in sectors like healthcare, industrials, transportation, automation of knowledge work. I think the opportunity for example, the Internet of production, the way in which the whole production process can be dramatically redesigned is going to be a big theme over the next 3 to 5 years.